Hi everybody, welcome to Deep Well Talks of Deepak Academy. Today we are diving deep into a crucial concept that affects every investor, no matter where or how they invest: systematic risk. This is the kind of risk you simply cannot diversify away. It's inherent in the entire market and is driven by large-scale economic or geopolitical events. Now let's understand how the systematic risk factors impact our investments and what strategies we can use to handle it. Interest rate risk. Interest rate risk affects the value of investments, especially bonds. When interest rates rise, bond prices fall, reducing their market value. This risk also impacts equities, real estate, and other interest-sensitive assets. To manage this risk, diversify across asset classes and maturities. Consider floating rate instruments and monitor central bank policies. Using bond ladders, that is, purchasing bonds with different maturity dates, or short duration funds or securities can also be considered. Reinvestment risk. Reinvestment risk arises when the income from an investment like bond coupons or maturity proceeds must be reinvested at a lower interest rate, reducing the overall returns. This is especially relevant in falling interest rate scenarios. For example, if you buy a bond yielding 7% today, but future coupons are reinvested only at 5%, your effective return drops. To manage reinvestment risk, consider laddering bond maturities, diversifying across asset classes, or using zero coupon bonds that eliminate interim reinvestments. Market risk. Market risk affects all investments due to factors like economic shifts, interest rate changes, or geopolitical events. These risks can lead to sudden price volatility and potential losses even in fundamentally strong assets. To manage market risk, diversify across asset classes, invest for the long term, and avoid emotional decisions during market swings. Regular portfolio reviews and aligning investment with your financial goals and risk tolerance can also be considered. Inflation risk. Inflation risk erodes the purchasing power of your returns over time. Even if your investments grow, rising prices can mean you actually lose value in real terms. Fixed income assets like bonds are especially vulnerable here. To manage this risk, diversify your portfolio with inflation-protected instruments like TIPS, real assets such as real estate or commodities, and consider equities which may offer better long-term growth. Remember, protecting against inflation is just as crucial as earning returns. Exchange rate risk. Exchange rate risk or currency risk arises when investments involve foreign assets. Fluctuating currency values can impact returns even if the investment performs well. For example, a rising rupee can reduce gains from overseas equities or bonds. To manage this risk, investors can diversify across geographies and asset classes, use hedging tools like currency futures, and regularly review portfolio currency exposure. Country risk. Country risk refers to the potential for losses due to political instability, economic shifts, legal changes, or currency fluctuations in a particular nation. To manage country risk, investors should diversify across geographies, monitor global developments, and consider investing through international funds or ETFs with built-in risk assessments. Geopolitical risk. Geopolitical risk like wars, trade disputes, or political instability can shake markets, disrupt supply chains, and cause sharp movements in currencies and commodities. To manage such risk, investors should diversify globally across asset classes, sectors, and regions. Staying informed and avoiding overexposure to politically sensitive markets can also be considered. Regulatory risk. Regulatory risk arises when laws, rules, or policies change, potentially affecting your investments. For example, new tax laws, stricter environment norms, or industry-specific regulations can impact company profits or even restrict certain investments. To manage them, diversify your portfolio across geographies and industries. Stay informed about regulatory developments and consider investing in companies with strong compliance practice. Liquidity risks. Liquidity risk arises when an investment cannot be quickly sold or converted to cash without significant loss in value in case of need. Real estate, small cap stocks, and certain bonds often carry higher liquidity risks. To manage this, investors should diversify their portfolio with a mix of liquid and less liquid assets, maintain an emergency fund, and regularly review their investment timelines. Being aware of exit strategies and market conditions can also be considered. So, investors who have expertise and time can manage systematic risk through these strategies like diversification, asset allocation, regular portfolio reviews, and hedging strategies. Understanding your risk tolerance and investment horizon is the key. Stay informed about macroeconomic trends and avoid reacting emotionally to market swings. Managing systematic risk is about staying prepared, not predicting the future. And investors who do not have expertise and time can avail the services of SEBI regulated managed portfolios. These professionally managed investment baskets are diversified across asset classes, sectors, and geographies. Skilled portfolio managers actively monitor economic indicators, adjust allocations, and implement strategies like hedging, rebalancing to manage volatility. Fund managers continuously monitor and adjust holding based on market trends, aiming to balance risk and return. This active management can limit exposure to underperforming assets and seize emerging opportunities. Being SEBI regulated ensures they follow strict guidelines, act in the investor's best interest, and maintain transparency. So, who are the SEBI regulated portfolio managers and how they are managing our investments? Let's see in the next video. Thank you.